and he will be speaking on ESG risk ratings, key features, and exposure framework. Mr. Marco, please.
Thank you for the introduction. Can you see my screen?
Yes, we can. Oh, no, it's gone now.
Okay, sorry about this.
Now we can view it.
Okay, perfect. So thank you very much, everyone, for your time today. My name is Marco Sepulveda, and I am the manager for the client advisory team based in Sydney. And my responsibility is to work closely with our clients to help them understand and integrate our research into their investment decision-making processes across Asia Pacific. Today, I'll be speaking to you, just a brief introduction about Sustainalytics, with the majority of the presentation focused on our ESG risk rating methodology and our research process. And then I'll finish off by sharing some market trends that we see across Asia and specifically in Malaysia. So a little bit of the introduction on Sustainalytics. So who we are, one of the world's leading ESG research houses that's been around for 25 years, focused exclusively on ESG research, human rights, controversial weapon, corporate governance. So it's our core business with a coverage of more than 12,000 companies globally, and a team that continues to grow and is sitting currently at over 900 professional staff members across 16 offices worldwide. And as you can see there, we work with asset managers, asset owners, custodian, index providers, depository and clearing houses, etc. So what do we do? So we serve investors across the value chain, and that includes, from pre-investment decisions to ESG integration and reporting, and that spans across voting and engagement services as well. A little bit of an overview of what our research coverage includes in APAC. So a research universe consisting of approximately 5,000 companies. You can see the breakdown there for your reference. And on the left-hand side, some of the use cases that our clients have for our research. And we can maybe talk a little bit more about that at the end. And I'm sure that there'll be some questions, so we can discuss how our research is being used for screening purposes, thematic investing, ESG integration, best-in-class approaches, etc. So a brief commentary on our team. As I mentioned before, 900 plus staff members, with more than half of our team dedicated to ESG research. And we'll share these slides with you, so I won't spend too much time here, but effectively highly qualified team distributed across the globe to provide our clients with very specific regional knowledge to drive best practice. Here, I'll spend a couple of minutes just to give you a background on our research approach. And this is our ESG risk rating research approach, which is the topic of our presentation today. So there's two research cycles that we have for our ESG risk rating. So one is annual, and then one is daily through our controversies, monitoring, and incidents and event assessments, as you see there. So the annual review and updates of our risk rating reports is conducted by our analysts, who are focused on reviewing publicly available information. And also the process includes an engagement process. So we actually seek feedback from companies before the ratings are published to ensure that there hasn't been any omission or misrepresentation of the research and the rating. And that process is done annually. And then there is an ongoing daily process which consists of our controversy research, which plays a very important role in our ESG risk rating methodology. And that is looking on a daily basis at 60,000 news sources to identify whether the companies in our research universe are involved in any controversies or incidents. If there is identification of a company's involvement in a controversy or an incident, there is a deeper analysis conducted by our controversy research team preliminarily, and then if the issue is deemed to be material to that company, financially material to that company, it's then passed on to the analyst who covers that company for further research and for company feedback, as you can see here. So that's a little bit of a snapshot of our research approach. And now I'll move on to talking about the ESG risk rating methodology. So at a high level, the ESG risk rating provides an absolute measure of unmanaged ESG risk. And as an absolute measure of unmanaged ESG risk, the lower the score, the better. And the approach that we take to quantify unmanaged ESG risk is two-pronged. The first is by looking at absolute exposure to ESG risk, and then assessing how well a company is managing that exposure to risk. So a couple of key messages here is because the score is absolute, the risk metric is absolute, it's comparable across companies, across sub-industries. And as you can see here on the last bullet, there's 5 risk categories from negligible to severe. And I've included a snapshot of Malaysia airports just to give you, a more tangible sense of what this looks like at a very high level for the ESG risk rating. So how do we actually construct the ESG risk rating? I mentioned that it's a two-pronged methodology focused on firstly exposure and then management. So the exposure side of the equation starts by looking at sub-industry exposure. So what we're doing is at the sub-industry level, we are looking at 4 factors to determine what are the issues that are financially material to that sub-industry and what's the degree of risk to these issues. So when I say issues, I'm referring to things like business ethics, corporate governance, carbon from a company's own operations, data privacy and security, etc. So the starting point is at the sub-industry level, and we have a 4-factor approach to determine the issues and the quantum of risk for these issues. So the first component is the industry view. So what are companies across that sub-industry reporting as financially material to their business? We then also reference international materiality frameworks such as the Sustainability Accounting Standards Board and the GRI. We leverage our in-house expertise. So our analysts are structured to cover sectors. So their sector specialism is leveraged as a part of the input to determine sub-industry material ESG issues. And last but not least, we have a quant process where we are mining our historical database of controversies across the sub-industry. And the reason why we are assessing the historical database of controversies across the sub-industry is to identify whether any of these issues may be more financially material than another. So because this process is conducted at a sub-industry level, the issues that are material at the sub-industry will vary across different sub-industries. The only constant issue that we assess as a baseline issue for all sub-industries is corporate governance. So what does this mean in practice? As I was saying, the issues that are relevant for a sub-industry may not be relevant for another. So for example, if we're looking at two very distinct sub-industries, we're looking at, let's say, integrated oil and gas, and we are comparing that to a tech company, the issues that are material to those sub-industries look very differently. And not only do they look differently, but the exposure to risk for those sub-industries is also significantly different. And that's the key message of this slide, that the starting points of exposure and risks to ESG are significantly varied across sub-industries. So once we've defined the financially material issues across the sub-industry, we then proceed to look at company-specific factors to determine whether a company is over or underexposed to these issues. So there is a 4-factor approach, which we call quant issue betas or beta factors, and these are used to assess company-specific exposure across the issues. So the first is, as you see there, product and production. So what type of products the company produces, where it's selling these products and services. Then there's a geographic components in terms of where the company operates, what's its jurisdictional exposure. We also look at financial metrics, and that's from two different perspectives. The first is to understand a company's ability. So we're looking at a company's financial health, and that is done to determine a company's ability to deal with potential penalties that may arise from involvement in controversies, or on the flip side, to invest resources in technology, processes, procedures that allow the company to better manage risk. So with these 4 factors in hand, we assess company-specific exposure to ESG issues. So once that's determined, that once the exposure side of the equation is defined, we then proceed to assess the management side of the equation. So in the management side of the equation, what we're looking at is effectively how well is a company managing its risks. And here we have, management indicators, which consists of, policies, programs, management systems, compliance, performance, and we're assessing all these indicators to determine the strength of management for each financially material issue for that company. And because we're looking at management indicators, in this case, the scores are from 0 to 100, with the highest being the best. So there's an event indicator on the right-hand side of that diagram. There's an event indicator, and that's related to controversies. So controversies play an important role in adjusting management scores when a company is involved in an incident or a controversy. And the reason this is the case is because involvement in controversies reflects a discrepancy between what a company says it's doing versus what's happening in practice. So to quantify this discrepancy, we penalize management scores where there's an involvement in controversies. And I'll talk a little bit about our controversy assessment process and scale of severity. So drilling one level down into the management indicators. So our methodology is fully transparent, not only in terms of how it's constructed, but also in terms of what we're assessing. And the details of what we're assessing, as you can see here, I've included a couple of examples, one focused on business ethics, the other focused on carbon products and services. So what what this framework of management indicators allows us to do is systematically assess standardized criteria to provide scores across our research universe. So you'll see a raw score, again, from 0 to 100, 100 being the best, a weight. So the weight indicates the level of significance that we are assigning to a particular indicator, in this case, bribery and corruption policy, and then a weighted score, which is a simple multiplication of raw score times weight. And what you see further below is the criteria that the analysts are looking at to assess the strength, in this case, of a bribery and corruption policy. So what's ticked off is what the company is doing and disclosing, importantly, and what's not ticked, in this case, definition of bribery or corruption, is what the company is not doing or not yet disclosing. Importantly, you also see the sources that our analysts have used to conduct this assessment on the bribery and corruption policy. And one important factor to mention here is that, as I noted earlier, one of the processes from our side before we publish an updated company rating is to seek company feedback. So if a company provides us with feedback on a specific indicator, you will see as part of the sources a clarification as to when the specific company provided the feedback. So that's the structure of management indicators, and I'm just going to wrap up the management side of things with our events methodology or our controversy methodology. So the controversy methodology is relatively straightforward in the sense that what we're doing is we're assessing companies' involvement in incidents, and what we're doing is really digging deep to understand the incidents, exceptionality, impact across the business, reputational, commercial, legal, and we're assigning a rating from 1 to 5, depending on how significant that controversy is. And the controversy research is important to highlight because, one, it has a key input role in adjusting the ESG risk rating score, but also it's important to highlight that the controversy research includes forward-looking signals, which we call outlooks. So the analysts for categories 3, 4, and 5, which is significant, high, and severe, the analyst includes an outlook, which effectively is our view as to whether an incident will improve or deteriorate for the company. And our clients are using the outlook assessment as a key input into forward-looking analysis on where the company may be headed on specific issues. So just to wrap up on the ESG risk rating methodology, as I mentioned before, the starting point is total exposure. So we are assessing what is the absolute exposure to risk that a company has across ESG issues. Again, highlighting that the issues that a mining company is going to have is going to be different to the issues that a tech company or a bank will have. So we're assessing company-specific exposure. Once we've defined the exposure score, we proceed to assess management. And here I'm going to talk a little bit about what we call manageable risk factor. The manageable risk factor is our quantitative view as to how much risk for a specific issue a company can manage. So what does that mean in practice? So if you think about, for example, an airline company, one of the issues that airlines are exposed to is carbon from their own operation. So because the business model for airlines is to fly airplanes which consume jet fuel, and due to the fact that there's no feasible alternative for jet fuel consumption for airlines, a large component of an airline's exposure to carbon emissions from their own operations is unmanageable, regardless of how strong the airline's policies, procedures, technology, and R&D is. There is a large component of that risk which remains inherent to their business and they cannot manage. So that is what we call manageable risk factor. And we do this across, this is applied across all sub-industries, across all issues. So some issues are entirely manageable, for example, like corporate governance, and some, like carbon on operations for airlines, are not entirely manageable. So once we've applied the manageable risk factor, and we've determined how much of the risk is manageable and how much of the risk is unmanageable. So this is the second row here. You can see a quantified measure of risk, which is manageable risk, and then a metric as well, a number of that quantifies how much of the risk is unmanageable. So once that's done, we proceed to assess how much of the risk that the company can manage is it managing. So that's the managed risk, and the risk that the company is able to manage, but they're not managing correctly or appropriately, or at least they're not disclosing that they're managing, is what we call the management gap. And the sum of the management gap, so the risk that the company can manage, but that they are not managing, plus the risk that the company is unable to manage, which is the unmanageable risk, gives us the unmanaged risk score, which effectively is the ESG risk rating score. So as I mentioned before, an absolute measure of unmanaged ESG risk. And because it's an absolute measure of an unmanaged risk, it's comparable across companies across sub-industries. So with that, I've concluded the ESG risk rating methodology, and I thought that I could share some market trends that we see in Asia. And here, the first point, which is quite evident, and I don't really have to talk too much about this, but we've all seen, Larry Fink's letters, using very strong words around their commitment to ESG and to responsible investing, voting against management and board directors when companies don't make sufficient progress on sustainability-related disclosures, and that's alluding to SASB and TCFD reporting requirements. We've also seen even locally some very strong words by EDF making commitments to applying ESG across all their portfolios by 2030. So there's a lot of strong words from very respected institutions. And we also see this reflected on the ground with the conversations that we're having with asset owners and asset managers in Malaysia and more broadly across Asia. So this slide goes to the point of how rapidly sustainable investing is growing. So this is a snapshot of the UNPRI, and there's more than 100 trillion US dollars from signatories to the PRI, and the PRI effectively is a voluntary framework that encourages signatories to assess ESG more broadly integrated into investment decision-making processes and report transparently about how this is being done across the organization and across the funds for that organization. And the growth is quite spectacular. In this instance, it's in 2019 it was 20%, but the numbers for Asia is much stronger. It's been 40% over the last 12 months. So this is significant, and we are also, the fact that there's so many new signatories in Asia just demonstrates the commitment and the speed of change at which this is being done and discussed in Malaysia and Asia and the ASEAN region more specifically. And one of the key reasons why we're seeing this widespread adoption and interest of ESG is because there is increasing evidence to demonstrate that ESG funds are very resilient, and in fact outperforming most of their non-ESG tools. So this is important because the performance barrier has been overcome, and also there is increasing demand from institutional and the retail market. So that's very important to highlight. And here you see some very interesting stats specifically related to climate and to low carbon. And this was produced by the Asian Investor Group in 2021. And it effectively just highlights how significant the growth has been, particularly on carbon, which is an issue that's on all of our clients' radar as a key priority, along with others like human rights and business ethics. But here you see the growth. If you look at portfolio tilting, significant jump in interest from just over 10% to close to 50%. Decarbonization strategies from under 30% to close to 70%. So there's a lot of action in this space, and it's being driven both by increasing sophistication from institutions, as well as increased sophistication from the retail markets. And to conclude, I wanted to show you this slide on sustainable funds flow. So here you see some significant jumps on flows, and you see that there is a large jump on rest of the world. Asia dominates this little green tab, and we've seen, and there's evidence across the market that's I think that in 2019, if memory doesn't fail me, in 2020, there was net inflows, strong net inflows across ESG funds or RI funds, whereas there were net outflows across other non-ESG funds. So, the trend is massive. We are talking a lot with institutional with asset owners and asset managers on ESG integration, on product creation, on how to position themselves competitively in markets where there is, growing appetite and increased demand for more sophisticated pools of capital, attracting capital from developed markets. So it is a trend that we see some significant growth currently, and in fact, Asia is one of our largest growing markets. So we don't see this slowing down anytime soon. We just see this accelerating. So with that, I've concluded the presentation, and I think we can open up to Q&As. I have the Q&A box open. I haven't received any questions yet, so I'd encourage the audience to shoot through any questions. We have a bit of time, so it'd be great I can answer any methodology questions or any market specific questions that may be of interest. So by all means, I might pause here to see if there's any questions that come through.
Hi, Marco. Hey, can you hear me?
Perfectly.
Hey, hi, morning. So it's Anand here. I'm sorry, I can't seem to access the Q&A box, so I thought I'd just go verbal. I just wanted to, maybe you could explain a little bit about the momentum indicator. That's something we see in all the Sustainalytics reports. And, there have been, I guess, various indicators that it is quite important to track the momentum ratings of these companies in terms of generating alpha from your ESG investments. Could you talk a little bit around that and how, do these indicators, or does the momentum indicator change dramatically from year to year in some cases?
Yes, absolutely. Thank you very much for the question. So I've changed slides to bring the snapshot of the first slide to talk a little bit about forward-looking signals that our clients are using. So you see here, this is effectively the cover page of the Malaysia Airports report. It's cut in half. There's a little bit more information underneath. But the key point to highlight here is that you'll see that for Malaysia, the Malaysia Airports example, you see that they have a 19.8 ESG risk score, which in this case is sitting on the higher end of the low risk bucket, which goes to 20. And importantly, you see a momentum, a momentum score of -1.7. And you see it in green because we're talking about measures and metrics of risk, right? So a reduction of 1.7 is a reduction of unmanaged risk. So it's a positive change. So this momentum score is used by our clients to track direction of travel for companies. And what's also important to highlight is that here, I guess you're looking at the cover page of the reports, but you can also drill down deeper to understand what's driving that change in momentum. So you'll see the momentum at the exposure level. So is the exposure to risk for the company increasing or decreasing? And you also see the momentum score for management. And the management score, the management momentum score is particularly important for our clients because that one is effectively what the company can control and what's in their ability to improve. That is the number that will best reflect that. So when there's positive improvements, the company is traveling in the right direction. So some clients, for example, like to use the momentum scores to identify companies where potentially there were existing management gaps, or there was involvement in a particular controversy that has affected the company. But given a strong remediation and rectification of the issue, a strengthening of management systems, management teams, and a steady improvement in performance, the metric is used to identify companies where there is potential for upside, where valuations may have made an opportunity quite attractive, and from an ESG perspective, the direction of travel is positive, where the issue is being mitigated and managed well. So our clients are using those momentum scores for that. And something that's important to flag and to mention, I'll just talk a little bit more about this because there's still no other questions, is that a lot of our clients, so the other forward-looking signal is related to controversies and the outlook of controversies. And the outlook, as I was mentioning before, can be either positive, negative, or neutral. And when a company has been involved in a significant controversy, there is interest from our clients to understand what they're doing to manage and mitigate that incident. So clients are leveraging our research team, which is accessible to them, to discuss, have more nuanced conversation on our views as to how the particular company is dealing with the issue, and whether to complement their views as to whether the company has done sufficient to become a good investment opportunity, or whether they are, on the flip side, doing not enough, insufficient amelioration of the issue where it warrants taking different action. So that's the approach that our clients are using, both from a risk rating momentum score, an exposure momentum score, the management momentum score, as well as the controversy analysis and the outlook for controversies.
Great,
So
very clear. Thank you. Thank you, Marco.
No problem. So I see a couple of questions have come through. Just bear with me while I read them. So one of the questions is it a fair statement to say that Sustainalytics risk rating has a natural bias towards the environment, given the overall unmanaged risk will naturally be higher for oil and gas industry as compared to a real estate industry? So the answer to that is no, not necessarily. So there are some industries which will have very different exposure to issues than others. So oil and gas, the oil and gas industry has, is a very E-heavy industry, but we have others that are very S-heavy, and broadly speaking, G is a baseline. So the response to that is, it's not that our ratings is biased towards the environment. Our ratings is looking at which are the issues that are financially material to that sub-industry, and those issues may have a combination of E and S factors. So just to give you an example of what this means in practice. So if we think about, let's say, a mining company, to focus on another high-risk industry, one of the issues that a mining company is exposed to is community relations. And within community relations, there will be E indicators and S indicators. So there will be indicators related to, for example, air and noise, pollution, and there will be S indicators related to community relation programs. So the example is intended to provide some clarity as to how we're assessing issues more broadly, and how there is a combination of ES and G issues in varying degrees across some sub-industries, where some will be heavy on E and others will be heavy on S. So then we have another question related to conglomerates, effectively, where the question is, there's multiple business, including construction, property development, manufacturing. How does Sustainalytics determine or consolidate risk exposure of a company's respective businesses? Do you weight the different business exposure, and what do you use to weight revenue? So that's a great question, and that's there's the starting point to that to answer that question is that the categorization of that particular conglomerate is done at the it's at the sub-industry level. So that's the starting point. And then, as I mentioned before, we're looking at company-specific factors to adjust exposure to these issues. So depending on the conglomerate's composition of businesses, in this case, the question included construction, property development, manufacturing. So depending on the conglomerate's composition, scope of business, scale of business, geographical footprint, sources of revenue. You know, what are the main sources of revenue across these businesses that may result in exposure being driven differently across the business units. That's the way that we would approach a complex, large conglomerate in that instance. So effectively, the short response is yes, we consider the scope of the company. You know, what are the products and services? Where are they selling these products and services? Where are they producing these products and services? And how much revenue are they generating, respectively? So there is a company-specific adjustment from that regard. So I believe we've answered all the questions. I don't know if there's any last ones. I'm aware that we still have a little bit of time, so I'm happy to take any final questions.
There seem to be no more questions, Marco.
Okay, well, look, hopefully this presentation was helpful. And if there's any questions from the audience, the presentation will be circulated, and my contact details are in the last slide. So please feel free to reach out directly. We're more than happy to answer any queries or support you with your ESG requirements. So maybe I'll leave it at that, and just once again wanted to thank MKE and Bursa for organizing this, and it's a delight to be here with you and support this conversation.
Thank you, Mr. Marco. Ladies and gentlemen, to all attendees to this session, please take note that all the speakers' presentation slides will be uploaded on Bursa website, available for downloading next week. And our next session will be at 12 noon.